Every time the market drops, retirees everywhere ask the same question. Should I sell before it gets worse? Should I move everything to cash? Is my retirement still safe? And I get it, because when you've spent 30 or even 40 years building your nest egg, seeing it drop in value overnight, it can feel terrifying. But here's what I tell every client worried about what the market might do next. It's not the crash that's going to ruin retirements. It's being forced to sell when it happens. The truth is, you can't control the market. You can't predict when it's going to fall or how long it's going to take to recover. But what you can control is how your income is structured. And if you do that right, with one simple three-part system, your retirement plan can keep paying you steadily through any kind of market conditions. This is the same system that helped my clients stay calm throughout 2008, through the pandemic crash, and through every downturn since. And once you understand how it works, you'll never look at your retirement income the same way again. Hi, I'm Mark Wisniewski, President of Southern Incomes. If you find this helpful, make sure to like and subscribe. And if you'd like to see how this three-part system could apply to your own portfolio, there's a link in the description where you can book a time with me. Now, let's dive into the three-part retirement system that keeps your income flowing no matter what happens in the market. The hidden problem in most retirement plans. Here's the truth. Most retirees don't have an income plan. They have an investment plan. Maybe they own a mix of stocks and bonds and mutual funds, a 401k here, an IRA there. But what they don't have is a structure on how to turn that pile of money into reliable, tax-smart paychecks. So when the market drops, they panic because their income is tied directly to their portfolio value. And that's the biggest danger in retirement, when your lifestyle depends on something that you cannot control. Without structure, every market swing it feels like a threat. But with the right system, those same swings become nothing more than background noise. The three-part retirement system explained. I call it the three-bucket system. It's not complicated, but it is one of the most powerful frameworks you can protect your retirement with. And here's how it works. 1, the short-term bucket. That's safety and spending. This is your sleep well at night money. It holds the next 1 to 3 years of your planned expenses in cash, CDs, or short-term bonds. The goal is not growth, it's protection. This bucket is going to pay for your living expenses regardless of what the market is doing. When the market drops, this is where your income comes from, not your investments. 2, the mid-term bucket. Stability and refill. This covers years 3 through 10 of your income needs. It might include higher quality bonds, dividend-paying investments, or maybe some kind of balanced funds. Its job is to slowly refill your short-term buckets when markets are stable and stay untouched when they're not. Think of it as the bridge that keeps your retirement plan running smoothly during those choppy years. 3, the long-term bucket. That's growth and inflation protection. This is your engine, the money you won't need for 10 years plus. It's invested for growth. Stocks, ETFs, diversified portfolios, because this is where you outpace inflation and protect your purchasing power over time. Even if the market dips, this bucket, well, it has years to recover before you ever need to touch it. Together, these three buckets, well, they create what I call financial time segmentation. What does that mean? Well, your income is protected today while your investments keep working for your future. Why this system keeps working, even if the markets don't. Most retirees who panic during market downturns have one fatal flaw in their plan. They're relying on their portfolio to fund today's income. So, When the market falls, they're going to be forced to sell shares at a loss just to cover their expenses. But with the three-part system, that never happens. Your income always comes from stable, short-term reserves, not your volatile assets. That gives your long-term investments time to recover. Well, it's not market timing, it's, I call it market insulation. You're removing volatility from your personal income, even though it's still happening inside of the portfolio. This is what turns a fragile retirement into a durable one. Let's say you're retiring with $1.8 million saved and you need $90,000 a year to live on. Well, here's how your three buckets might look. Your short-term bucket, remember, that's 3 years of expenses, $270,000 in cash or short-term bonds. Your mid-term bucket, that might be $500,000 in income-producing investments, maybe bond ladders, dividend funds. Your long-term bucket, that's going to be the remaining $1,030,000, and that's in growth-oriented investments designed to beat inflation. Now, let's say the market does drop 25%. Your long-term bucket, it's going to take a hit, but your short-term and mid-term buckets are untouched. You have 6 or maybe even 7 years of reliable income sitting safely outside of the market. You keep living exactly as you were. You don't panic, you don't sell, and you don't lock in those losses. When the market recovers, and it always has, your long-term bucket grows and refills the others. You see how that works? That's how your income stays steady throughout any kind of market cycle. The tax advantage most people overlook. This system doesn't just manage market risk, it also manages tax risk. Here's how it works. Each bucket can hold different account types. Short-term bucket might be your taxable accounts or other after-tax investments for your flexibility. Your mid-term bucket, well, that's traditional IRAs or your 401ks for your deferred income. Your long-term bucket, Roth IRAs, or other tax-free growth vehicles. And by drawing from these buckets strategically, you can control your taxable income every year, staying in lower tax brackets, reducing those Medicare premiums. That's how you turn a market-resilient income plan into a tax-efficient one, too. Why most people don't build this system. Most investors, they never learn this. Why? Because traditional financial advice is focused on accumulation, not distribution. Let's face it, for over 30 years, you've been told to buy and hold and just ride out that volatility. But in retirement, that advice no longer works the same way. You're not saving anymore. You are spending. And when you start spending from the wrong places at the wrong times, you're going to expose yourself to the one thing your portfolio cannot recover from: sequence of return risk. The three-bucket system eliminates that risk by separating your income needs from the market's ups and downs. It's structure, not speculation, that keeps your retirement working for you. When retirees finally see their plan broken in 3 clear buckets, I'd say something changes because they stop checking the market every day. They stop worrying about whether the Fed is going to raise interest rates. Well, they stop reacting emotionally because now they can see exactly where their income is going to come from years to come. And that's the real benefit of this system. It doesn't just protect your money, it protects your peace of mind. Here's the bottom line. You can't predict the markets. You can't avoid volatility, but you can design your retirement income so it keeps working even when the markets don't. That's what this 3-part system does. It gives you structure, confidence, and control so you can focus on living your retirement, not just watching the markets. If you want to see how to apply this system to your own situation, how to balance your income, manage your taxes, and protect your plan from those downturns that are going to come, book a call with me using the link in the description. Thanks for watching, and remember, the market may be unpredictable, but your income doesn't have to be.